Welcome back to Cheddar Business. In just a few moments, Federal Reserve Chairman Jerome Powell will testify before the House Financial Services Committee about the state of the U.S. economy. This as the coronavirus continues to plague markets around the world. Joining us now is Chad Morganlander, Portfolio Manager at Washington Crossing Advisors. Chad, it's always great to have you on the show. How do you think the coronavirus outbreak changes Powell's testimony today?
So I think he's just going to give and express a view of caution and that they're observing what exactly develops and if it does start to affect the United States and growth here in the United States. But overall, the message and the general thematic is going to be one of quite dovish support for the financial markets as well as the economy.
As it relates to the coronavirus, do you expect similar commentary from Powell as we had heard when he was giving his speeches in the height of the trade war? Data-driven approach, we're going to exercise patience. Are there a lot of the same themes there?
Right, and that's exactly right. It's just also they're going to mention that it's transitory, that perhaps, and the hope is that this will last for 3 months. And then, of course, the economy will kick back into full gear in China. There'll be a tremendous amount of fiscal stimulus within China that will lift asset inflation as well as inflationary trends. So this is what the message that he's going to send, as well as the market is looking past this in the belief that global growth will then kick higher in the second half of the year.
So Chad, is this why we're seeing markets not take a bigger hit on more concerning news about the coronavirus? Is it because of that expectation that this will be transitory?
Well, right, and you know, I don't know if that's going to actually come to fruition. God willing, it will be transitory. But overall, equities are priced into perpetuity in future free cash flows. That's the way portfolio managers and analysts look at individual companies. So overall, they're looking past the next 6 months, saying, okay, what kind of growth is in 2021 into 2022, and what type of valuation should we put on that growth? Hence the reason why you see the equity markets doing what they're doing. And then you look at the fixed income markets, they're a little bit more subdued and a little bit more cautionary with interest rates coming down across the board, across the globe over the last several weeks.
Despite the coronavirus, despite the trade war, we keep seeing markets hit record high after record high. What are the biggest indicators in your mind that point to sustainability of these markets?
So if you go back to last year, 2019, what you noticed then was that interest rates across the globe went down by 1 to 1.25% across the entire curve. That, we believe, is what lifted assets and markets in the United States. We believe that investors should keep a careful eye on the interest rate environment, not only here, but within Europe. Also, you should look at global growth and global demand. We haven't seen over the last 10 years a real true drop-off of global demand. Yes, we've seen a deceleration, but nothing where it raises the risk of a recession. This may be the first hurdle, this issue that we're dealing with right now in regard to the coronavirus. We'll have to be path dependent and watch this very closely over the next 3 to 4 weeks.
Chad, thinking out for the remainder of the year, what are you pricing into your models with regard to political risk right now? Is President Trump likely going to win the elections this year in November, or does he face competition from some Democrats at this point? And if yes, how does that upend markets?
Well, you have to remember that it's literally 1% one way or another that can determine the election, like it did back in the last election cycle. Overall, I believe that the financial world is looking at the strong economy and the strong market and expecting that the incumbent will get in, because historically they did. With that said, though, there remains a lot of unknowns in regard to this new election cycle. If a Michael Bloomberg takes the lead, he's a pro-business type of view, has a pro-business viewpoint. He resonates very well with small business owners, hence the reason why he may have a big showing in Pennsylvania as well as in Florida. So There's a lot of question marks, and as at this point, what we're factoring into our model, as well as how we're leaning into it, is that we're modestly overweight U.S. equities going into this. We're underweight emerging markets, and in fact, we have eliminated our EM and we're staying with higher quality equities within the U.S. markets.
The strength of the economy has been one of the major talking points for President Trump in his re-election bid. As we get closer to the election, do you expect more rhetoric or even more movements on trade agreements, whether it's a phase 2 or beyond, or even more pressure from President Trump to Jerome Powell to cut interest rates, really anything to boost investor sentiment?
Yeah, well, that's going to be a guarantee that he's going to push the Federal Reserve to lower interest rates. And the interest rate assumptions going into the end of the year is roughly about a 1/4 percentage point reduction, about a 40% expectation for that. When it comes to the economy, our expectation is a 2.25 to 2.5 growth rate with GDP here in the United States. Overall, that's far lower than what the current administration is forecasting, but well above the inflation, the expectation by the Federal Reserve. So growth rates here in the United States could support valuations unless there's this dramatic drop-off within aggregate demand. But that's how we're playing it. We have a 5% expectation of a total return here in the United States, not only for 2020, but for 2021.
Yeah, the growth rate estimate from you, much more realistic given what we've seen in recent history, despite the huge tax cut to corporations. Chad,
right.
Where are we in this recovery right now?
So, people say that we're in the later half of the recovery. Typically, recoveries start to, recessions start when there's a tremendous amount of capital investment that then gets reduced. Think about the housing crisis back in 2007. We're not seeing a tremendous boom within capital investment here in the United States that would actually maybe trigger a recession. So we continue to believe that the federal deficit is supportive of at least a 2% handle on growth. We have roughly about a 20% type of probability of a recession, which is still, historically in range. So we're really not concerned about the United States. My major concern would be China, as well as the emerging markets. We think growth there is going to be awful in 2020, and then that the longer tail of growth there is going to continue to decelerate due to this reduction of growth within credit in China. So focus on the emerging market growth overall for the next several years.
Chad Morganlander, Portfolio Manager at Washington Crossing Advisors. Always great to see you. Thanks for joining us.
Thank you for having me.